Good morning, everyone. Can you hear me? Can you hear me? Shall we start the session? Can we start the session now? Are you able to see my screen too? Are you able to see my screen? Everybody is seeing the screen, right? Are you able to see the screen? Can you hear me? Voice not out. You cannot hear me? You cannot hear me? Is it okay now? Can you see me? Can you hear me? Hello? 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 Can you hear me? Hello? 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 Yeah. Can I continue then? Can I continue? Good morning, everyone. Today we are going to discuss about marginal costing. The marginal costing is one of the important technique in management accounting. This marginal costing technique will help to understand. We have to understand at what level we can make our sales targets and what level we can make our production strategies. So all this can be understand with the help of marginal costing technique. So let us understand how it will be helpful for us. So one of the important areas of marginal costing are profitability and production planning. So we have to assess what will be the profitability position of our company, what can be the production levels of the company. This is one of the two important areas that has to be met by the management accounting concept. Okay, so the profitability position is determined based on the cost structure of manufacturing and operating activities of the company. So basically, depending upon what kind of expenses we are incurring, and based on that, we can make a sales strategy, and then accordingly, the profitability position can be determined. So mostly, manufacturing and operating costs are classified as variable cost and fixed cost. So this is a basic classification across all the industries, where the manufacturing or operating costs are broadly classified into two categories. Mostly that they are fixed cost and or the variable cost. Fixed costs are those costs which will not be changing and they will be remaining irrespective of whether you are irrespective of whatever be the level of production activities, this fixed cost will be common and it will be incurred regularly. Contrary to this and against this are the variable cost. Variable cost will not be incurred all the time. They can only incur based on the production level. So this is the difference between fixed cost and variable cost. Where fixed cost remains same, the variable cost will not be remain same. Variable cost will not be remain same. There are different types of costing and cost accounting rules or techniques are available for the purpose of this cost ascertainment and allocation of cost to various departments and various products. So under cost accounting, what we will do is we will have different types of models and we will have different types of techniques that are available to classify the fixed cost, classify the variable cost, and ascertainment of fixed cost and the ascertainment of variable cost. So accordingly, we can assign fixed cost to different departments and fixed cost to manufacturing of different products. Similarly, the variable cost can also be assigned with respect to different departments and with respect to various products. So what marginal costing will do? So marginal costing based on the data that was generated from cost accounting, they will have uses some mathematical rules and mathematical formulas, and using those mathematical rules and mathematical formula, under marginal costing, we can able to define the relationship between the cost of the product and the volume of the product at which it can be sold and what kind of profits it can be generated. So therefore, marginal costing can help in the assessment of profitability position of the company. Then, let us now understand what is the basic concept of marginal costing. So as we already know that marginal costing uses the information generated from cost accounting and financial accounting and uses some mathematical formula to calculate the relationship between profitability, sales, and the production levels. So under this, as we already know that expenses will be broadly classified into two categories: fixed cost and variable cost. Fixed cost and variable cost. And normally, in valuing the cost of an asset, we will be taking full cost. Full cost means we will be taking into fixed cost and variable cost both into account for the determination of cost of the product. Cost of the product. Based on the cost of the product, then we will decide what can be the selling price of the product. So under absorption costing or full costing, what we will do is we will take all type of expenses. We will take both fixed cost and we will also take the variable expenditure. But unlike the absorption costing, under marginal costing, we are not going to take the fixed cost. Marginal cost takes only variable cost into account for the determination of the cost of the product. They will consider variable, they will not be considered the fixed cost. They will only consider the variable cost. And whatever the cost that, how a variable cost then can be defined. So variable cost is defined as the change in the cost of the product when we manufacture an additional unit or when we manufacture additional product. So if there was increase in the production level, say for 1 unit of increase in the production level can increase the cost of that level by that single unit, cost of that single unit. That cost of the single unit can be called as marginal cost. So under marginal costing, what we will do is we will only take variable cost. We will not be taking fixed cost. So we will not be taking the fixed cost. All the other costs will remain similar. So accordingly, we will analyze the cost and accordingly we can analyze the cost of the product for a single product or for a single department, and then accordingly we can forecast the sales and we can forecast the profits using the formula that was defined under marginal costing technique. Marginal costing technique. So what are the characteristics of marginal costing? So what we are going to do under marginal costing? So under marginal costing, as we already told that marginal costing takes only into consideration broadly cost can be divided into fixed cost and variable costs, but only variable costs are taken into consideration for the determination of the cost of the product. Fixed cost will not be taken into the account. And also marginal costing can be applicable only for valuing or for a single business unit or a single product. It cannot be used for a combination of different units or different business units. It can be considered as a standalone technique for the measure for the cost cost of manufacturing a single business unit or cost of manufacturing a single product. Therefore, ascertain on marginal costing. So under marginal costing, what we will get is we will can define uh, as we are not as we are taking only consideration into as we are taking only variable cost into consideration. The assumption under marginal costing is that after deducting the variable cost, whatever the amount we are going to get, it should cover the fixed cost that we are incurring. So, and then after the fixed costs are covered, we have to only after the fixed cost is covered, then only profits are taken into consideration. So, this contribution, which includes which is derived after deducting the variable cost, can be considered as a contribution because this will basically contributes to cover the fixed cost earlier, and then it will cover the profitability in the second place, and it will help us to determine the relationship between the production level, sales volume, and the profitability. So using this marginal costing technique, profitability of each department and each product can be determined. Marginal costing provides a logical basis. It will give you a logical and way of determining the sales prices, and as well as it will also help in making the uh, tendering processing contracts where we have limited scope. Where there is limited scope, we are offering very limited products or where our scope of business is very limited to a particular product or particular service. And so marginal costing technique will help us to make a tendering process easier by determining, by making us to project the sales volume or profit volumes, preferably, most probably not exactly, but it will help to give you an idea about what can be the sales volume and what can be the profits according to the sales volume. Then let us understand some of the limitations of marginal cost. See, under marginal costing, the fixed cost division of fixed cost into division of cost into fixed and variable cost is difficult. So we cannot be exactly defining the variable cost and fixed cost under marginal costing. This is one challenge under marginal. Though they will speak about the fixed cost can be defined and variable cost can be taken into consideration, but in practice, determining both of them is very different. The differentiation, making the differentiation a bit difficult. Marginal cost may be useful for short-term assessment of profitability. So this will help us to make an assessment only for a short period of time, or for, say for example for 1 month or for 2 months or 3 months like that. So it cannot be helpful to make a long-term profitability analysis of the company based on the sales volume and variable cost. So because now it cannot take long-term perspective into the consideration. So marginal costing technique will only helpful in determining the short-term profitability of the company. So marginal costing does not provide any standard for the evaluation of performance. See, under marginal costing, what we will do is we can only determine what can be the sales for a desired level of profit. What can be the sales at a particular variable cost. But it cannot give you any standards against which you can measure the performance of the company. So it will only give you a point where up to level the sales can be increased, up to where a profitability can be increased, considering the variable fixed cost. So all through the analysis, the assumption is that the product sales price per unit and variable cost will not be changing. So the sales per unit and variable cost per unit will be same. Based on that, the volume of sales and profitability position can be determined. When there is a change in the sales price per unit or variable cost per unit, then the application of marginal costing cannot be possible. Marginal costing. So under marginal costing technique, as we are avoiding the fixed cost, so automatically what happens is that when you are valuing the finished goods or work in progress, so that fixed cost value cannot be reflected in the finished stock goods and in the work in progress category. So automatically the value of value of the stock, finished stock will come down under marginal cost. Whereas under the absorption costing, there will be taking both fixed cost and variable cost. So it will reflect the true value, but under marginal costing, the value of stock will not be similar, unlike that of unlike that of absorption cost. Yes. Well, as I already told that based on the information generated from the cost accounting reports and financial accounting reports, so using the mathematical formulae, marginal costing technique helps us to understand what the sales and cost and profitable relationship between sales, cost and profitability can be understood. So accordingly, we know that the basic formula for the calculation of profit is that sales minus variable cost minus fixed cost. Sales minus variable cost minus fixed cost is equal to profit. As I already mentioned that under marginal costing, fixed cost can be excluded. Fixed cost can be excluded. So only variable cost is taken as the actual cost that is incurred for the manufacturing of the product. So the basic marginal cost equation is that after excluding the fixed cost and it is taken into the profit margin, the marginal cost equation will become sales minus variable cost is equal to contribution margin. So when we are deducting the sales value from the when you are deducting the variable cost from the sales value, whatever the amount we are getting is called as contribution margin. Why we are calling it as contribution margin is this amount what we are getting is it should contribute first for the coverage of fixed cost. Then only it will be considered to be covering the profit figure. So this is the basic equation of marginal costing. So based on this equation, we will able to define different measures for analyzing the performance of the company. So let us understand what will be the basic uh, uh, components that can be derived from this basic marginal cost equation. The first important thing is that, as we know that, first important thing is the PV ratio. PV ratio. How a PV ratio is calculated? PV ratio is nothing but what we have calculated now. What we have calculated as contribution margin. Contribution margin is the difference between sales and variable cost. And if that whatever is coming, if you are calculating that amount as a percentage of the sales figure, normally that is the profitability percentage. That's what we normally do. As we are taking it in a much broader way, that means it has to cover the fixed cost initially. That's why we are considering it as a contribution margin ratio. So it is calculated as a percentage of sales value. It is calculated as a percentage of sales value, and this PV ratio will be helpful to do cost volume and profit analysis. Will be helpful to determine break-even point. Break-even point is nothing but a point where we will not be getting any profits or losses. That is the point where we will be covering the fixed cost in the manufacturing process. And the margin of safety is the point where we are ahead above the cover, where we are ahead of covering the fixed cost. And CVP analysis is nothing but it will be helpful to understand what will be the profitability position for different levels of sales sales process. So irrespective of how many number of units you are sold, this profitability PV ratio will be remaining same because it is calculated based on the selling price per unit and variable cost per unit. Unless the selling price per unit and variable cost per unit changes, the PV ratio will not be changed. PV ratio will be same for any volume of sales. PV ratio will not be changing at any cost. So it will help you to calculate the contribution margin on the total value of sales. So the formula for contribution margin ratio is sales minus variable cost by sales into 100, or it can be calculated as sales per unit, selling price per unit minus variable cost per unit divided by selling price per unit into 100. This is the basic, this is the PV ratio. Are you able to hear, right? Everything is okay, right? Can I continue? Right? Hope you are all hearing. Okay. There is any problem, please mention. Please speak something. If there is any problem. Then the next one is after contribution margin ratio. The next one is how to calculate the break-even point or break-even sales. So break-even point or break-even sales is the level of sales where there will be no profits or no losses for you. So using the marginal cost equation and the contribution margin, we can define the break-even point in terms of units and in terms of volume. In terms of volume, at the break-even point, what will happen is the sales will equal to the fixed cost. That is, the contribution is equal to the fixed cost, and there won't be any profits at that level. So whatever the sales that will be deriving after the break-even point will only be considered to be the actual profit generated by the company. As we already mentioned that the basic assumption under marginal costing is sales minus variable cost is equal to contribution margin. Contribution is nothing but fixed cost plus the additional profits that can be derived. So by calculating the break-even point, we can understand the point where we can cover the fixed costs also. The break-even point will give you an idea about what is the sales level at which we can cover all the fixed costs. So based on that, what we can say that after the break-even point, whatever the sales we are getting, it is considered as a profit for the company. So the calculation of break-even point, formula for the calculation of break-even point. So a break-even point can be calculated as fixed cost divided by PV ratio or for value. So if you want to determine in terms of value, what we can do is fixed cost can be divided by the PV ratio. And if you want to get number of units, break-even units that are sold, what is the formula is break-even point is in units is equal to fixed cost divided by contribution margin per unit. Contribution margin per unit is nothing but selling price per unit minus variable cost per unit. Contribution margin per unit is equal to selling price per unit minus variable cost per unit. So this is the formula for the calculation of break-even point or break-even point in units, break-even point in value. And then next derivative is the margin of safety. What is margin of safety? See, margin of safety now, so far we discussed about uh, contribution. Contribution is equal to coverage of both fixed cost and profitability. And break-even point is the level where we will be covering fixed cost, and after that we will be getting the profits. Then what is margin of safety? The margin of safety level of a company will starts from the break-even point. That is, margin of safety indicates the profitability level. So considering from the break-even point, at what is your profitability level? How far you are from the break-even point? How much margin of safety you are having from the break-even point? So break-even point is the level where we are not getting any profits or losses. But after that, we should be deriving the profit. So to get an idea about after covering the fixed cost, what will be your actual profit? What will be your actual profit? It can be covered using margin of safety equation. Margin of safety is the it is one of the margin of safety can be derived from the marginal cost equation only. So as I mentioned that it is the sales value above the break-even sales value. Indicates the profit margin. The value of margin of safety indicates the profit margin after covering the fixed cost. The formula for the calculation of margin of safety is simply we can do like this. Margin of safety is equal to actual sales minus break-even sales. Actual sales means what is the actual sales? Out of that, break-even sales indicates the value of sales that is covering the fixed cost, or that is the level where we are not getting any profits or losses. So after deducting that level, we will get the value of actual sales. We will get the value of margin of safety. Then in margin of safety can also be calculated as profit divided by PV ratio. Profit divided by PV ratio also will give you the margin of safety value in total amount. So this is the one of the derivative of marginal cost equation. Using marginal cost equation, we can determine the margin of safety position. That is how much profit you are getting after reaching the break-even sales volume. That is after covering the fixed cost. What is your safety position? This margin of safety equation will help you to understand that position of the company. The next one. So the major contribution of marginal costing is that using this marginal cost equation, what we can do is we can also fix the sales target for an expected level of profits. It will help you to define what can be your sales value or what can be your sales unit by using the formula sales projected sales in value is equal to fixed cost plus desired profit divided by PV ratio. So using this formula, we will be having a fixed cost value and we will be defining certain amount of profit that we can be derived. And at a standard level of sales and selling price per unit and variable cost per unit, we can calculate the PV ratio. So using these components, we can determine the projected sales. for a desired profit. Once you're changing the profit level, the sales values also will be changing. So as per your production capacity or as per your desire of generating the profit, we can fix the sales target. We can also define the number of units that can be sold to get the expected profit from the sales volume. These are the basic formulas that we use under marginal cost. So using these formulas, so under marginal costing, there are different scenarios where we can apply the concept of where we can apply the marginal costing principles using the contribution ratio or PV ratio. So PV ratio will help to give you an idea about defining the sales target and production volume. So let us understand some applications of marginal costing in a practical business environment. See, can you hear me now? So far everything is okay. Are you hear me? No. Can I go to next section? I'm going to next topic. Okay. Are you hearing my? Uh, can you see my presentation? Yeah. Okay. Then the next. See, let us see the applications of marginal costing. So marginal costing technique can be helpful in the following areas. It can be helpful. It can be helpful in the following areas. It can be helpful in the following areas. Uh, First one, pricing decisions, product and production decisions, profit planning, profit planning, level of activity, level of activity is nothing but at what will be the production level. So we can also define what can be the we can also define what can be the we can also define the profitability of dropping a product line, or we can also define what can be the profitability of introducing a new product line, or we can also define what kind of product and sales mix decision that we can take, and also we can take make or buy decision whether to manufacture a product or whether to sell a product. So these are the important applications of marginal costing. So marginal costing technique help to understand will help to take decision under these categories. So under pricing decision, the pricing decision is one of the important component in the determination of profitability of the position. The fixation of selling price is dependent upon the cost structure and the expected profit. So if you have a cost structure and if you are having an expected profit levels, so by using the marginal costing technique, we can determine an appropriate selling price. It should not be an exact selling price. At least we can define a reasonable level of sales price can be determined. So using the CVP analysis, that means by increasing the sales price and by decreasing the sales price, we can calculate different contribution margins, and we can also define what can be the optimum level of that can be derived by defining different selling price units. So accordingly, we can fix the cost of selling price per unit. The marginal cost equation provides an opportunity to provides an opportunity. So we can define different sales volume, and we can increase the number of units, or we can decrease the number of units. We can increase the sale price, or we can decrease the sales price. So accordingly, we can fix a price which is more profitable to the company. So in this way, marginal cost equation will help in the pricing decision, fixing of the selling price of the product or any target price for a department to be achieved. Product and production decisions. So again, it is similar to defining the selling price, but when it comes to it is about what kind of products we have to manufacture and what kind of production activities we can undertake. Here also, the contribution margin will help us in defining the cost and profit relationship. By assessing the contribution margin for different products, we can understand which product mix or which product composition is helping us to increase our profitability margin. Depending upon the profitability level, by taking into consideration the contribution margin, so we can for different products and different production mix, we can understand what can be the actual profitability of the company, actual profitability of each product. So accordingly, we can take a decision to which product that we can consider that will be helpful for the optimization of our production process and the maximization of our profitability. So most probably the optimum product mix will be the highest combination of products or product mix that is having the highest contribution margin. And the next important one is profit planning. Profit planning is nothing but like fixing of selling price. So, but here we will take here also it is also similar, where we will make a comparison between selling price and where we'll make a comparison between variable cost, and where we will be determining the uh, profitability levels of the company. So, how we can do the profitability planning? The profitability planning can be done based on increasing the volume of sales. So, we can define, we can see when by increasing the sales volume, we can see that there will be increase in the profitability level. If increasing the selling price, we can see there was an increase in the selling price. So, uh, by decreasing the variable cost or by decreasing the fixed cost also, we can increase the profitability position of the company. So this PV ratio or the combination of different elements will help you to understand the profitability planning of the company. At what level they can make the planning for the profit to increase the profitability level. Level of activity planning. So level of activity planning is that it is about determining our production capacity. So the company may not always be functioning at 100% capacity. They will be functioning as per their requirement. So taking into consideration the production level of the company. So at a different production level, we can calculate the contribution margin at a different production level, and we can, based on that, we can determine the profitability level, and wherever we are contributing. So if there was a more profitability opportunity, if we are increasing the production level, then we can increase the production level. Or if by increasing the production level, if there is any problem, then we can take a decision as to which level the production can be reduced. So based on the contribution margin at different production level, the level of activity can be determined using marginal costing technique. Similarly, for introducing a new product, or for dropping an existing product. So when we are manufacturing two or more products, and if you are want to remove one product, so after removing that one product, we can as usually calculate the contribution margin of the other products, and we can see the difference between what will be the contribution margin when the new product is in there, and we can see the difference after the new product was removed. So if there was any loss after removing the new product, we can see that we can see that dropping of the product is not good, or else we can say that the product dropping of product ratio is good. Similarly, introduction of a new product. So after introducing a new product, we can also calculate the contribution margin of the existing as well as the new product, and we can see the contribution margins that were derived after adding the new product. So accordingly, we can decide whether the new product is creating any value addition to the company or not. Make or buy decisions and key limiting factors for the under the marginal cost. So make or buy decision is also the thing that it refers to the purchase of a component from the outsiders. So we can see the profitability. So when we purchase the product from outside, what will be the cost difference when make it in the company? If there was a major change in the cost structure, if you make the product in the company, then outside we can go for the manufacturer. Or else, if you benefit out, if you benefit by making an outside purchase, we can go for the outside purchase. So in this case also, the marginal costing technique helps us to understand what will be the profitability if the product is manufactured in the company, or if it is purchased from the outside. So in this way, marginal costing technique will help to understand about the profitability levels by making a decision regarding making or to buy a product. What is meant by key limiting factor? The key limiting factor is the constraints that will stop us making optimum decisions under marginal costing technique. See, simply keeping values in the formulas and finding out numbers is not the case with the marginal cost. So there will always be some constraints. So that constraints will be in terms of production levels or in terms of sales of the company. So it will define the range within which we can measure the contribution margin for a specified level of production or for a specified level of sales per unit. So the resources constraints can also be in terms of machine hours, labor hours, raw materials, even the market demand. So this will always have an impact on the contribution margins that we are defining using the marginal cost equation. So we there was an influence of these factors when we are defining the marginal cost, when we are defining the contribution. Somebody can mute this sound now. Disturbance is there. Please mute. So these are the applications of marginal costing technique. So just one time let us recall those applications, then we'll go for problems. So what are the decisions that we can take using the marginal cost equation or contribution margin? We can take a pricing decision or fixation of sales prices. We can decide about the production of which kind of products can be manufactured. Which we can also decide on the production level of production activity. We can define the profitability levels. We can decide whether dropping or adding a new product is good or bad. What kind of product mix or sales mix will give you a better profitability position. So we can also make a buy or decision with respect to manufacturing or selling of a product. And all these decisions can be made within a defined parameters. So taking those parameters into consideration, limits can be defined with respect to production volume or sales volume. Accordingly, the profitability levels can be determined under the marginal cost. So these are the basic theory points that are helpful to understand the concept of marginal costing. So let us try to understand. Of application of marginal costing. Try to solve some problems in this area so that we will have an understanding of marginal costing. Let us discuss some problems here. So these problems can be solved using the formulas, whatever the formulas that we have learned now. What we discussed so far is that marginal costing technique helps you to understand the relationship between cost, that means what is the cost of manufacturing a product. Are you able to see my screen? Problems. Can you see the screen? Can you see my screen? Okay. See, under marginal costing, the basic assumption is that fixed cost will be remain similar and only the variable cost will be taken into consideration for the determination of profitability at different sales level. So using this marginal cost equation and contribution margin, we can determine break-even point. That is the point where we will not be having any profit or losses. We can also project sales margins. We can also project for the sales figures. We can also define what can be our sales target to achieve defined profit margin. So whatever the formulas that we defined under marginal costing will help you to define these areas. See, let us see the first problem here. Let us try to understand the first problem. So a product is sold at a price of 120 rupees per unit and its variable cost is 80 rupees per unit. The fixed cost of the business for the business are 8,000 rupees per year. Now what we have to calculate is here. We have to calculate break-even point in value and break-even point in units. So what is the formula for break-even point in value? Break-even point in value. break even point in value. What is the formula we learned? Break even point in value is equal to fixed cost divided by PV ratio. So we should have a PV ratio now. What is the formula for PV ratio? PV ratio is equal to selling price. PV ratio is equal to selling price per unit minus variable cost per unit. Variable cost per unit. Variable cost per unit. That is equal to rupees 120. Variable cost per unit divided by selling price per unit. That is equal to rupees 120 minus rupees 120 minus here selling price per unit is equal to 120. Given in the problem, variable cost per unit is equal to rupees 80 given in the problem. So 120 minus 80 divided by 120 divided by 1. That is equal to rupees 40 divided by rupees 120 into 1. Into 100. 40 divided by 120 into 100. So 40 divided by 120 into 100, 40 divided by 120 into 100. Into 100. Into 100. That is equal to 33.33%. Equal to 33.33%. So this is the PV ratio. So now how to calculate the break-even point? So break-even point, the formula for break-even point in value is, the formula for break-even point in value is fixed cost divided by PV ratio. Fixed cost, what is the fixed cost given in the problem as 8,000 rupees. 8,000 rupees divided by PV ratio is 33.33%. 33.33%. That is correct. So, 0. This is equal to 24,000. So break-even point is 24,000. So 24,000 is the level where we will not be getting any profits or losses. Break-even point, sales value. This is the level where we are not going to get any profits or losses. That is, it is the level where it will cover the fixed cost as well as the variable cost. So break-even point in units. How to calculate break-even point in units? Equal to formula. Break-even points in units is equal to fixed cost divided by contribution margin per unit. That is equal to rupees 24,000 divided by contribution margin is nothing but rupees 120 minus 18. It is equal to rupees 24,000 divided by 1. It will give you the number of units, number of break-even point units, 24,000 divided by 600, 600 units. So if you sell 600 units, there will not be any profit or loss. 600 units if you sell, there will not be any profit or loss. This is the first point, break-even point in value and break-even point in units. So what can be the profits? What can be the profits when you make a sales of 240 units? It's very simple to calculate. What will be the profits if you make a sales of 240 units? So this 240 units sales is equal to 240 units. So this can be simply multiplied by contribution margin. So contribution is equal to 240 units into 240 units into rupees 40. 40 is the contribution. That is 240 into 240 into 40. 9,600. So rupees 9,600. 9,600 is the contribution margin. Okay. What is actually contribution margin? It is nothing but fixed cost plus profit. Fixed cost plus profit. That is equal to rupees 9,600. So what is profit? Now actual profit is equal to 9,600 minus rupees 9,600 minus fixed cost. That is equal to fixed cost was given in the problem as rupees 8,000. Therefore, rupees 9,600 minus rupees 8,000. That is equals to rupees 1,600 is the actual profit. Actual profit. This is the second point. Third point. Sales to be made to earn a net profit of rupees 5,000. So for this also we have a formula, projected sales formula. So projected sales formula is projected sales is equal to projected sales is equal to projected sales is equal to fixed cost plus desired profit divided by PV ratio. Divided by PV ratio. So here the fixed cost is rupees 8,000. It won't change. Plus what is the expected profit is 5,000 rupees. So what is the PV ratio? PV ratio is equal to divided by PV ratio 33.33%. So this 8,000 plus 5,000 is equal to divided 39,000. So sales volume can be 39,000. That means we can have to sell at least 325 units. 325 units we have to sell. How you will get 325 units? Rupees 30,000. This is the profit. This is the sales value that we have to get. Projected sales. This is the projected sales value. You have to get a profit of 5,000. So in units, if you have to get units, in units, projected sales in units is equal to rupees 39,000 divided by selling price per unit. That is equal to rupees 39,000 divided by 120. That is equal to roughly we will be getting 120. So we have to sell 325 units. So this is how we can apply the marginal cost equation for the determination of break-even points in value and in terms of units. And also we can determine what can be the profits if there was an increase in the increase or decrease in the sales value, and also for a planned profit, what can be the sales value. So these are the three levels where the uh, uh, marginal cost equation or the contribution margin will be helpful. Audio is not. Can you hear me now? Can you hear me? Can you hear me? Hello? Can you hear me? Hello? Can you hear me? So let us go with the second problem. Okay. Second problem. Am I audible or not? Hello? PV ratio. See again PV ratio. PV ratio is equal to PV ratio is equal to calculation of PV ratio. First point. PV ratio. Here also. So we have given this following information for a period of 1 month. We have to calculate PV ratio. PV ratio is equal to sales minus the selling price per unit minus variable cost per unit divided by selling price per unit. Selling price per unit. So in the problem, 2000 units were sold at a cost of rupees 80,000. That is equal to number of units sold. Number of units sold is rupees 80,000 divided by number of units. selling price per unit is equal to selling price per unit is rupees 80,000 divided by number of units. That is equal to 80,000 divided by 2,000. So selling price per unit is rupees 40. Variable cost per unit. Variable cost per unit is also calculated on selling total is also calculated on selling price. That is equal to rupees 80,000. Number of units sold is also calculated on number of units sold. That is equal to rupees 56,000 divided by 2,000 units. That is equal to 56,000 divided by 2,000 is equal to rupees 28. Variable cost is the 28. Therefore, selling price per unit is rupees 40. Variable cost per unit is rupees 28. So, contribution margin or the PV ratio is equal to rupees 40. That means selling price minus that means 20 divided by 40 equal to 50%. 50. PV ratio is 50%. So first point is calculation of PV ratio. This is the process for calculating the PV ratio. We can calculate selling price per unit by taking into account the total sales and the number of units sold. Similarly, variable cost is also can be calculated on the number of units sold, because under marginal costing, we will only take variable cost into consideration. So 56,000 divided by number of units sold is equal to 28 rupees. So contribution margin or PV ratio is equal to selling price per unit minus variable cost per unit divided by selling price is equal to 50% is the PV ratio. So and contribution per unit is also same. Contribution per unit is nothing but contribution per unit. Contribution per unit is rupees 40 minus 20. That is equal to rupees 20 is the contribution per unit. 20 is the contribution per unit. Next, calculation of break-even point in units. Calculation of break-even point in units. Formula is equal to fixed cost is equal to fixed cost divided by contribution per unit. That is equal to rupees. Fixed cost is 18,000 rupees given in the problem, divided by rupees 20 is the contribution per unit. So contribution 18,000 divided by 20. So break-even point is at 900 units. 900 units is the break-even point level. This is the level where the contribution margin will cover the fixed cost, and after this we will be whatever the profits number, any unit selling after this 900 units will be the profitable unit. So whatever additional units will be generating the profits of the company. So margin of safety, again, margin of safety is nothing but the amount of actual sales minus break-even sales. That is the sales that is deriving after whatever the sales that we are getting beyond the break-even point is called as margin of safety. So margin of safety in units can be calculated as is equal to actual units sold, minus break-even sales, break-even units, break-even units. It is equal to actual number of units sold were 2000 units. Break-even point is 900 units. That means what is the profitable units level? 1100 units. So margin of safety is that these are the units that were sold beyond the break-even point. That is, after covering the fixed expenses, all these units are covering the all these units are generating the profits to the company. That means, see, for example, 1100 units were sold. So 1100 units, after 1100 units into, if you take 1100 units into contribution, then if you subtract contribution fixed ratio from the uh, if you subtract fixed cost, we will get the actual profit. Okay. So as usually, as how we calculated, so what is the additional profits we are going to get if the sales were increased to 1,10,000? It's very simple here. So additional profits, additional profits, additional profits at increased sales volume, increased sales volume. So what is the increased sales volume? 1,10,000. 1,10,000 into contribution. 1,10,000 into contribution margin per unit gives you the fixed cost plus the profit. That is rupees 20 equal to 1 lakh, sorry, total sales. Additional sales were increased. Sales were increased. Well, increase it to additional profits at sales. The sales were increased to 1,10,000 at 120 rupees per unit is equal to how many units? Sir? How many units? 1,10,000 divided by 1. So 916 units were sold. 916 units were sold. Total additional units that were sold. Additional units sold. Sorry. It is 1,10,000. Sales were increased to rupees 1,10,000. So if you calculate this PV ratio on this 1,10,000 into PV ratio. So 1,10,000 into PV ratio, that is 33.33%. PV ratio is 50%. PV ratio is 50%. PV ratio is this contribution margin is 55,000. So contribution margin covers both fixed cost and profit. So after this is the contribution margin. After subtracting contribution margin, we will get actual profit. At actual profits at rupees 1,10,000. That is rupees 1,10,000 minus fixed cost 18,000. That is equal to rupees 92,000. 92. This 92,000 is the additional profits, 92,000. Okay. This is how to calculate uh, increased sales on the additional profits on the increased sales volume. This is the second problem. And the, the third problem also similarly we can apply using the break even, using the marginal cost equation. Third problem, but let us discuss this fourth problem here. Then again we'll come back to the third problem, because this third problem I think this there was very assignments problem. So I will try to explain this. See what is this here is, here we have three products that were manufacturing. There are three products that were manufacturing by a company. So they wanted to drop one product and they wanted to increase the production capacity of other units. So what product they wanted to drop is that they wanted to drop product A. After dropping the product A, they wanted to increase the production capacity of product B and product C by 50%. So how to, whether whatever the decision that they have taken is correct or not, we have to determine that. So how to determine this? See, once we drop in the product A, so here also based on contribution margin only, we can determine the profitability of product, which combination is correct. So how to determine the contribution margin? First, here also we have to calculate the contribution margin. For calculating the contribution margin for each contribution for margin for the increased capacity. Increased capacity, we have to calculate the contribution margin. So after dropping the product A, we are increasing the production capacity of product C and product B and product C by 50%. That is 2,000 units were 2,000 units were increased to 3,000 units. 3,000 units of product B, 3,000 units of product B, and 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 5,000 units of were 5,000 units of increased to rupees were increased to 7,500 units of product C. Once units were increased to 3,000 units of product B, and 5,000 units of were increased to 7,000 units of product C. So we have to calculate the contribution margin for this. What is the contribution margin? Contribution margin is nothing but variable cost minus sales minus variable cost. So selling price of product B is equal to selling price of product B is 360 minus variable cost. Variable cost is the, from the total cost. This is the total cost. Out of this total cost, fixed overheads are 9 rupees. So if you reduce this fixed cost, that will be the variable cost. So 47 minus 9 is equal to 47 minus 9 is equal to 38 rupees. 47 minus 9 is equal to the variable cost is 38 rupees. 38. So contribution is equal to rupees 22. Contribution on product B is contribution on product B. Contribution on product B. Similarly, selling price of product C. Selling price of product C. Selling price of product C is 61 rupees. Selling price of product B is 61 rupees. Total cost is 53. 53 minus 10 rupees fixed cost, fixed overheads if you remember. Then variable cost will be 43 rupees. Variable cost will be 43 rupees. So 61 minus 43. 61 minus 43. Contribution is rupees. Contribution margin on product B is 18. On product C is 18 rupees. On product C is 18. So now, how many units? The production capacity was increased from 2000 to 3000 units, and product C capacity was increased from 5000 to 7500. So this contribution margin will give you the fixed cost plus profit. Let us see fixed cost plus profit. So product B equal to 3000 units into 3000 units into it is 22. 3000 units into 66,000. 66,000 is the contribution from product B. Product C contribution is equal to 7,500 units. 7,500 it is 18. That is equal to 7,000. 7,500 units into 18. Okay. So after removing product 1 and after increasing the production capacity of product B and product C, so the contribution on product B and product C will be 66,000 and 1,35,000. If you add this, you will get the total contribution from these two products. That is 2 lakh rupees, 2 lakh 1,000. 2 lakh 1,000. Okay. So after removing this product A and after increasing the production capacity to 3,000 and 7,500, we are getting the contribution margin as 2 lakh 1,000. Out of this, what we have to do is we have to subtract the fixed cost. Here we have given the fixed cost for all the 3 units as 6 rupees, 9 rupees, and 10 rupees. Irrespective of whether we are producing product A or not, this fixed cost will not be changed. Irrespective of what kind of product is manufactured or not, this product fixed cost will be similar for all the 3 units, or whether you carry production of 1 unit or whether you drop the production of 1 unit. So total fixed cost can be taken as on the base value. On the base value, we have to take the total fixed cost. That is product A is equal to 3,000 units into 3,000 units into rupees 3,000 units into rupees 6. Product B. Product B is equal to product B is equal to 2000 units into 2000 units into 2000 units into 9. Product C equal to product C equal to 5000 units into 10. This is equal to is 18,000. Is 18,000. This is equal to again 18,000. Then this is equal to again this is 50,000. 50,000. The total fixed cost will be total, total fixed costs will be this. We have to add these three components. Three components. 86,000. 86,000 is the total fixed. Profitability. Profitability from increasing the production capacity of P and C is rupees 2 lakhs 1,000. That is the contribution margin minus fixed cost. That is 86,000. 86,000. So 86,000. This will give you the 86,000. This gives you 15,000 is the profitability quotient. So after dropping product A and after increasing product B, production capacity of product B and C, our profitability margin is 1,50,000. So to decide whether this is a correct decision or not, what we have to do is we have to calculate the profitability at the original capacity. Original capacity in the sense when we are manufacturing three products without dropping the first product. When if you are manufacturing three products, at that level we have to calculate. That means we have to calculate the contribution for product A. Again, product A at 3,000 units. That is equal to actual profitability. Actual profitability. Actual profitability is equal to product A 3,000 units into 3,000 units into 3,000 units into contribution. We have to calculate the contribution for product A also. Product A also. We have to calculate product A is 27. That is equal to 30 contribution. Is 30. 1,000. 69,000. 2,000 units. 2,000 units. 44,000. Is equal to 5,000 units. 80. 5,000 units. The contribution from three products at the actual level. Total contribution from all the three products at actual capacity. Actual capacity is equal to sum of these three figures. 90,000 plus 44,000 plus 39,000 is equal to 1,73,000. This is the contribution from 3 units. So out of after this contribution, you deduct the fixed cost. That is 86,000. So minus 86,000 is 87,000. 87,000. So what is the actual problem here? Here the problem is that a company is manufacturing 3 units, A, B, C. So they decided to drop one product and they have to increase the production capacity of B and C, and they wanted to know whether it is profitable or not. For this purpose, what we have to do is that we have to calculate the contribution margin at the actual capacity and contribution margin at the revised capacity. So first what we did is we calculated the contribution margins at the revised capacity. So before going to that, what we have to understand is that the total fixed cost, irrespective of the volume of production, the fixed cost will be same. So we have to take the fixed cost level at the basic level. The basic level is that for 3,000 units, the fixed cost per unit is 6 rupees, and for 2,000 units for beef manufacturing beef product is 9 rupees, and product C it is 10 rupees. So by taking these three figures per unit, we can calculate that fixed cost as 86,000 rupees. Fixed cost of the total manufacturing capacity, total manufacturing operations. Manufacturing operations is rupees 86,000. So once this fixed cost is decided, we have to calculate contribution margin for three products. Contribution margin is nothing but sales minus variable cost. Contribution margin is nothing but sales minus variable cost. See, for product A, selling price is 40 rupees, product B is 60 rupees, product C is 61 rupees. The variable cost is deducted after removing the fixed cost from the total selling price. It is 27 rupees, is 38 rupees, and 43 rupees. The contribution per unit for product A is 13 rupees, and product B is 22 rupees, and it is 18 rupees. So taking these contribution margins, we calculated the contribution at revised capacity for product B. Contribution at revised capacity. At revised capacity. At revised capacity, we calculated contribution for product B and C. That is, we increased from 2000 to 3000 units, and here we increased from 5000 to 7500 units. Taking this contribution margin, the total contribution after revision is 2 lakh 1000. So once if you remove 86,000 fixed cost from this 2 lakhs 1000, we will get the profitability after revising the production capacity. So to decide whether this whether the production capacity, change in the production capacity added value or not, we have to calculate the contribution margin at the actual production capacity. For that, we calculated the contribution margin for 3 products at original capacity. So it came out as 1,73,000. So this is 1,73,000 is the actual contribution at the actual capacity, and this 2,01,000 is the revised capacity. So if you continue with manufacturing of 3 products at the same level, we'll get contribution as 1,73,000. After deducting the fixed cost, we'll get 87,000 as the profit. And at the revised level, by increasing the capacity of product B and C, the contribution margin will be 2,01,000, and after deducting fixed cost from this, the profitability will be 1,15,000. So what we can say is that the change in the production capacity will increase the profitability margin of the company. The change in the production capacity will increase the profitability margin of the company. So this is how we can use the marginal costing technique to determine the sales margin, to determine the profitability margins, to fix your production volume, to fix your selling price, to fix your variable costs, and then we can do a cost profit volume analysis so that we can come out with a specific level of sales where we can get maximum profit, and we can also define a specific level of production level where we can maximize our sales volume. This is about marginal cost. Any doubts are there? Anybody is having any doubts? Any clarifications? Only this is a very simple logic we have to follow based on the PV ratio, based on the relationship between contribution margin and fixed cost. That is, sales minus variable cost by selling price is equal to fixed cost plus profit. So this is the only relationship that will help you to determine all these components. That is break-even point and selling price and also margin of safety. Profit margins can be determined. Any doubt is there? Hello. Okay. Shall we wind up the session? Any doubts? Any doubts? No. Okay.